Okay, guys. I think we recorded problem number 12 2 well, okay, wrongly recorded. Okay, then. As per inter-level valuation completed, as per final level value per share also completed. It's a basic version of value per share. When it come to valuation of assets and liabilities, on that chapter, there is a special concept name called valuation of share in different approaches. Are you okay? Okay, done. Now, when it come to inter-level capital budgeting. So before that, financial management. So I already said financial management also be part of the valuation. Why? Because valuation is a multidisciplinary nature. Clear. Now when it comes to financial management, uh, a financial manager of a company focusing on three major decisions. CFO need to take a three best decision. If you take it the best way, automatically company will grow as per FM. The first decision is called funds procurement decision. That is nothing but financing decision. Guys, clear? Next, after procuring the funds, we have to invest in a best manner. That is called investment decision. If you do best financing decision and best investment decision, then only we talk about what, sir? Dividend decision. If company have a profits, then only we will talk about the dividend. If company don't have a profits, we are not talking about the dividend. Yes or no? No. So if you take a best investment decision, means you return need to be a maximum. If I invest 100 rupees on any company or any project or any shares, I need to get a maximum of the return. If I taking a loan from the outsider for the investment, I need to pay minimum cost. The maximum return, minimum cost set off, you will get an extra benefit. That is called profit. Guys, clear? If company have a profits, then only we will discuss about the profit decision in a technically dividend decision. Yes or no? No? For this financing decision purpose, you have to focus on three chapters: cost of capital, capital structure, leverages. Guys, clear? Huh? Don't write, just understanding purpose. This all you know. So when I come to the financing decision, when it will be best means if CFO have a sound knowledge in cost of capital chapter, capital structure, as well leverage. Guys, clear? When it comes to investment decision, it talks about two types of investment: long-term investment and short-term investment. If I procure 100 crores with the least cost, with the best mix, with the least risk. Cost talks about cost of capital, mix, best mix, optimum mix is talks about capital structure. Next, risk talks about leverage. If consider these three, I taken 100 crore rupees. Guys, clear? If I put that 100 crores in my business, means I'm investing on two things. One is short-term assets, long-term assets. Plant and machinery are all covered under long-term investments. Procurement of raw material is all covered under short-term investment. Clear? Now, if you want to take a good decision, best investment decision, you have to learn two things called capital budgeting. For short-term purpose, working capital management. Are you clear? So if you take a best decisions, then we will talk about the dividend decision. Dividend decision is not a part of our discussion. Are you clear? Now, so why I am explaining this intermediate stuff means you have to understand two things. Income statement. Income statements have a two different nature. As financing point of view is different and as investment point of view is different. Now when it comes to financing decision point of view, observe the income statement. We start with the sales. Less variable cost. Sometimes they're using a word called cost of goods sold. Variable cost or cost of goods sold. All talks about direct to the production cost. If you reduce this, you will get an answer name called contribution. You can also use a word called variable profit. Variable profit. On that variable profit, you have to reduce operating fixed cost. Why? Because fixed cost are have a two definition, not definition, classification. Operating fixed cost, finance fixed cost. So for example, rent, salary, insurance, depreciation, interest. These five are the known fixed cost. Are you clear? So the word interest is not related to the product. Remaining four is there now. These four are related to the product. That's why we are using this four is known as operating fixed cost. Here I am not considering interest. It talks about finance. So after reducing the fixed cost, you will get an outcome name called EBIT. Alternative names are very, very important. This EBIT is known as operating profit. This EBIT is known as business profit. This EBIT is known as organization profit. Guys, clear? Now, out of this EBIT, first you have to settle to debenture holder cost. That is nothing but interest. As well, here you need to learn one thing. Interest is a burden to the company. That's why department saying that we will give a tax advantage. Before paying the tax, deduct your interest expenses. Before paying tax, if you deduct means your taxable profit, what happen? Reduces. You can pay less taxes. Guys, clear? Now, if you reduce interest, you will get an outcome name called EBT. So this alternative name is taxable profit. In exams point of view, they are using a alternative names. Very clear? Next, out of this EBT, we have to settle tax. Why? Because government is a hidden part now. Are you clear, sir? They give us roads, they give a police, they give a infrastructure. That's why we have to pay tax. After payment of tax, if you have any amount in your hand, that is known as net profit. Net profit. So technically known as PAT or EAT, earning after tax. But what is the alternative name? Net profit. Very, very important. Your requirement is PAT, but in question they're using a word called net profit. Students will be confused. Where is a PAT? The net profit is nothing but what? PAT. Clear? So out of PAT, as a owner, I settle to all people. Before EAT, I settle to all people. I settled first variable cost, I settled operating expenses, I settled interest, I settled tax. Now what are the profit in my hand? I can share as a owner. But if your company have a preference share capital, at the time of entering into the agreement, you promise to him, before sharing my profits, we will pay as a preference dividend, preferred payment. So if company have a preference shares, you have to settle preference dividend. If you don't have a preference share capital in your company, thus net profit can be shared by all equity shareholder. That time you can use the word EAT is nothing but EASH. Now less preference dividend as a preferred payment. After settle them, if you have money in your bank balance, that is known as EASH. Technically also be known as equity earnings, equity shareholder earnings. Guys, clear? Out of this you can share 100%. Out of this you can share part payment. So for example, if we share only 50%, what about the remaining 50%? Returned earnings. Guys, clear? If you want EPS, divided by number of shares. So you will get a called earning per share. Guys, clear? Any doubt on this? So this is an income statement as per which decision? Financing decision. Here one word I missed. The word is known as depreciation. Why? Because if I invest only, I consider the depreciation. What I am doing here? Financing. Finance. At the time of finance, there is no asset, no depreciation. Guys, clear? After 1 year completion, both will be happen. Depreciation is there, interest is there. On that time, we are using a word called EBITDA. Earning before interest, tax, depreciation and amortization expenses. Guys, clear? Huh? But at the starting of the company, there is a no depreciation at the time of finance. Are you agree for this? Sure. Now let us come with the income statement as per investment decision. Here also it start with sales. Less cost of goods sold or variable cost. Contribution. Less operating fixed cost. So you will get here, you don't use the word called EBAT. Here you have to use the word called EBDT, earning before depreciation and tax. Here I am not focusing about the finance. Here I am only talking about the investments. If I am not focusing on the finance, means interest is not my cup of tea. Yes or no, sir? That's why you can ignore the interest portion at the time of where? Investment decision. Are you okay? As well, in investment decision, we are doing a present value calculation. We're doing what, sir? Present value calculation. At the present value discounting means we are reducing the value. Discounting means what we are doing? Reducing the value. The reducing the value means how you get a KO? KE into weight of equity plus KD into weight of debt. That KO includes what? Interest. That KO includes interest. If you're discounting means you are automatically you are what you are doing? You are reducing. Yes or no? No? If in KO you are reducing, as well as if we reduce here also, what happen? Double impact is happen. That's why here we are not consider interest. Very, very important point. Guys, clear? At the time of where we are considering KO point of view, we are using per discounting. Discounting means reducing the value. Reducing the value means automatically here also deducting only, na? If you at that case you are reducing, if you reduce here also, it is a double reduction. It is not a prompt decision. Values are not a prompt values for taking a decision. That's why here I am not taking interest. Hope you guys you understand why I am not reducing interest. Why I am using here depreciation. Clear? Done. So after getting EBAT, you have to do what, sir? Less depreciation. Why, sir, you are reducing depreciation? Means same tax department saying that depreciation has a tax advantage as per section 20 or 24? 32. As per section 32, depreciation is a tax deductible. If you reduce before payment of tax, what happens? Your taxable profit is reduced, you can pay less tax. Every company taking advantage or not taking advantage? Every company is taking advantage. That's why they are reducing the depreciation. Are you okay now? Done. After reducing the depreciation, you will get an answer. EBT is known as taxable profit as per investment decision. On the taxable profit, you have to pay tax. So you will get EAT, earning after tax. Earning after tax. Here we are not talking about the equity shareholder. Here we are not talking about the preference shareholder. Here we are not talking about the debenture holder. Here we are talking about the entire organization. Very clear? Now, in capital budgeting, we are focusing on cash concepts, not on accrual. What's the mean for accrual? Accounting of received and receivable, paid and payable. What about the cash concept? Received or paid? Yes or no, sir? So that's a principle they're following in capital budgeting. It means depreciation is a non-cash expenses. Depreciation is a non-cash expenses. You have to readjust. Hope you guys clear. So that's why after getting EAT, we have to add depreciation. Then you will get an answer name called CFAT, cash flow after tax. Cash flow after tax. So this is the income statement as per investment decision. Hope you guys you understand. Now one student had a doubt, sir, why you are reducing the depreciation, why you are adding again the depreciation? Then don't consider. Then don't consider. If you not consider, your answer will be same, na? No. If I am not considering depreciation, I am losing my tax advantage. I am losing my tax advantage. That's why initially I decreased, reduced. I get a reduced taxable profit. After getting a tax advantage, I know the concept. It is a cash concept. That's why non-cash expense will be readjust. Guys, clear? Readjust means what? Already deducted. Now readjust means add. Clear? So if you know this, we can solve the next problem given in our material. Clear? Any doubts on this? So alternate names are okay. Come to illustration number 16. Wait. Few concepts are missed here. So after knowing the income statement, techniques of capital budgeting is there. Techniques of capital budgeting. When it comes to techniques of capital budgeting, they are classified into two types. Non-discounting and discounting. So non-discounting means not consider time value of money. Discounting means consider time value of money. What does it mean for time value of money? Today rupee is not same as future rupee. Today rupee is not same as future rupee. There is alternative definition. Today rupee is more valuable than the future rupee. Yeah, today rupee is more valuable than the future rupee. Future value have a less value. Simple. 10% present value factor. Today value 1 rupee. At the end of the 1 year, 0.9090. Which one is a more value? Today. Guys, clear? Don't confuse. Today rupee is more value than the future value. Or today rupee is not same as future rupee. Now I will justify. Today is 1 rupee. Future it is more than 1 rupee. That is the equivalence. 1 equal to not 1. 1 equal to 1.1 is the equivalent. Clear? Done. So if you have any future values, if you take a decision based on future values, it is called non-discounting techniques. So 6 we are taken as example. Out of 6, sum of 6's is known as 30. Yes or no, sir? If you take a decision based on 30, that is called non-discounting technique. After that, we done one thing, multiply with the present value factor. We get something 24 rupees. That's if you take a decision based on 24, that is called time value of money discounting technique. Are you okay? Now we have a lot of techniques in intermediate stage, but when it comes to the final, they're focusing on only two things. The first one is net present value. The first one is net present value, and the second one internal rate of return. Internal rate of return. So this concept I will explain at chapter number 7, valuation of assets and liabilities. Concept name called YTM, yield to maturity. At the time of yield to maturity, I will give a clarity about the IRR as well as YTM model. Now we have to learn about the net present value. When it comes to net present value, NPV equals to present value of operating cash inflow plus present value of terminal cash inflow minus present value of cash outflow. So in simple terms, in interest stage, you learned sum of a discounted cash inflow minus sum of a discounted cash outflow. So because of less explanation, I recorded total. So here you have to do 3 working notes for every NPV calculation. One is operation, how much cash received from day-to-day activities. Day-to-day activity means selling of commodity. That is nothing but this income statement. Sale is my day-to-day activity. Yes or no, sir? At that say, due to that sale, how much cash I received is known as CFAT. Not only day-to-day activity, there is another cash inflow is there in your organization. That is called terminal, end of the life calculation. As per capital budgeting, end of the life calculation only scrap value. End of the life only scrap value. Just for example, I will give a clarity. Scrap value. But when it comes to further of our valuation, terminal value means we already calculated in previous problem. Perpetual value. That also be alternative name terminal value. As per capital budgeting, terminal value definition is different. As per valuation, terminal value is definition is different. You have to understand. I will give a clarity at the time of calculation. Guys, clear? Now, so this entire thing talks about only capital budgeting. So when it comes to working note number 1, estimation of, sir, 4 to 5 problems is there, sir, in final level based on NPV. In every MQB, model question paper is there, na? At that model question paper also, they're touching the NPV concept. Not on a inter-stage standard, they're asking in final stand. You can observe this question. It's not a inter-stand. In inter-stand, it's a 14 mark question, not 7 marks. So working note, estimation of present value of cash outflow. Estimation of present value of cash outflow. Cost of project or asset is known as outflow. Cost of project or cost of asset is known as cost. Present value of cash outflow. Why? Because you have to purchase. You have to purchase. Guys, clear? Now, add installation charges. Are you agree for this adding installation charges to the asset value? Why? Because what expenditure it is? CapEx, capital expenditure. Are you okay? Now, less subsidies any given by a government. Subsidies. Less subsidies. So if you take directly cost of the mission is not a cash outflow. You have to adjust relating to the specified point set by a question. Guys, clear? Done. Less subsidy. The next one, important one, add working capital. Add working capital. Add working capital. Guys, clear? So at completion of 3 working notes, I will give a clarity about the working capital. As of now, these all are outflows for the company. Very clear? If out of the cash from your pocket, this is nothing but company pocket. That is nothing, all are outflows. Sir, You said present value, no? But you are not multiplying with present value factor. This all are take calculation at day one. This all are calculating at day one. That's why you need not to multiply with present value factor. This always at present only. Clear? Sometimes they will touch point like this. Working capital is there, na? I invested at third year. If I invested at third year, now can I take direct working capital value as a present value? No, you have to bring from third year to 0. Are you clear? This cost of project is there, na? I paid in installment. The project value is 10 lakhs. I paid 9 lakhs at today. Remaining 1 lakh is there, na? I paid at third year ending. Now that 9 lakh is at present, but 1 lakh is there, na? It is a future. You have to bring. That kind of adjustments, there is a chance for asking in final standard. Are you okay? Apart from this, there is another important point. Less sale proceeds. Less sale proceeds. Write it down in brackets. Only if it is a replacement decision. Sale proceeds only if it is a which kind of decision? Replacement. Apart from the replacement, there is a no topic of sale proceeds. Apart from the replacement, there is a no topic of what, sir? Sale proceeds. It means sale of old asset. Sale of old asset is known as sale proceeds. Guys, clear? Okay, done. After adjusting all those things, you will get an answer name called present value of cash outflow. Any doubt on this present value of cash outflow calculation? Anyone? Okay. Next. Working note 2. Present value of operating cash inflow. Present value of operating cash inflow. You already calculated CFAT, na? In above income statement. CFAT. Into present value factor, you will get a present value of operating cash inflow. If single year, go with the present value factor. If second year, go with the second year present value factor. If it is a third year, go with the third year present value factor. Clear? Or CFAT into present value of annuity factor. Do you know the annuity factor concept? What is annuity factor concept? If every year have a same cash inflows, don't calculate year wise. Directly take one value, multiply with the all sum of present value factors, you will get the same answer. Guys, clear? So there is no need of explanation about the annuity factor. So when we are using means if you have a same CFAT for all years, if any break on that, don't use annuity factor, go with the individual year calculation. So that's it, working note number 2. Next, working note number 3. Present value of terminal cash flow. Present value of terminal cash inflow. When it comes to present value of terminal cash inflow, the first terminal value is salvage value. What is the first value? Salvage value. That is nothing but scrap, man. When it realize every year at the end of the life. Are you clear? Now there is a lot of discussion in salvage value also. For example, we are following straight line basis. They provided 4 years of life. 4 years of life. What happened at the end of the 4th year? Asset value. If you follow straight line basis, at the end of the year, what happened? Asset value 0. Every year you will charging portion of the amount. At the end of the 4th year, asset value is 0. But you sold for 15,000. As per books, what is your asset value? You sold for what? Which value? Can I use the word capital gain? You have to pay capital gain tax. Less tax on profit. Tax on profit. Tax on profit. Are you clear, sir? Okay. We are followed a WDV method. What happened at the end of the fourth year? Asset value 0 or not 0? Something is there. For example, in our books, the value is 10,000. We sold for 8,000. Can I use our capital loss? So Bhaskar sir taking a tax on profit. Automatically we will ask, sir, give me return back. Yes, sir. Capital loss. Add tax on loss. Why add? We are calculating benefits. Salvage is a benefit. Payment of tax is a disadvantage, reduced cost. Payment getting a benefit is a advantage, adding. Hope you guys you understand salvage value calculation. Clear. Now another important point here, add working capital. Add working capital. So you will get a terminal value. If you multiply with the present value factor, you will get an answer name called what? Present value of terminal cash inflow. If you completed this, I will give a clarity about the working capital. Guys, clear? Huh? Okay. Now take a just some small example to understand working capital. I procured 10 crore, 1 crore rupee from the outside, all sources, for petrol bunk construction. So I need to plan a build a business called petrol bunk in SR Nagar. I procured 1 crore rupees. By spending that 1 crore is all sufficient for land procurement, machinery, all. So after investing 1 crore rupees, all will be completed. Plan one petrol bunk setup is completed, but there is no petrol. Can I start my business? That's why I procured some amount of rupees 50, some amount name called 30 lakh rupees from the outside for purchasing only petrol. If I take that 30 lakh rupees or 20 lakh rupees, go with any one of the example, 20 lakhs. If I purchase with the help of the 20 lakhs, I sell petrol, again collect the 20 lakhs, again use the 20 lakhs for purchase of petrol, again I sold, I will collect the money, again I use that money for collection, use it for purchase of petrol. In every time it is circulating. In every time it is circulating. The 20 lakhs either in the form of petrol or either in the form of cash. Can I take in between of the third year or fourth year? Can I procure the 20 lakhs? Can I take the 20 lakhs from the business? If I take the 20 lakhs from the business, my operations will be stopped. Are you clear, sir? When I get that 20 lakhs again means if I stop my business, I am not ready to sell any petrol to anyone. Then my cash will be in my hand. Then only I can collect that 20 lakhs. Hope you guys clear? Initially you put it as an investment. See this. Add working capital. 20 lakhs as an investment. I can't collect in between the 5 years or 10 years. When I can collect or realize? Where? Terminal means end of the life. Clear? Till date it will be circulate. That's why working capital is also be known as circulating capital. Working capital is also be known as circulating capital. It has a two adjustments. Initially you have to show investment. It will be realized when? If a business closes. If business is not closes, that working capital will again circulate. Either in the form of stock or either in the form of cash. That is the nature of the working capital. Clear? Done. Now open problem number 16. For only solving this problem, we revised all capital budgeting technique. Only for one particular problem. Illustration number 16. Newly added in your workbook. అర్థమైంది వర్కింగ్ క్యాపిటల్ క్లియరా? అది ఉంటే మనకి క్యాష్ ఫామ్లో ఉంటుంది, లేదంటే స్టాక్ ఫామ్లో ఉంటుంది. నువ్వు దాన్ని క్యాష్గా తీసేసుకున్నావు అంటే స్టాక్ కొనలేవు. క్లియర్? క్యాపిటల్ లేదనే కదా దాన్ని తెచ్చుకునేది మనం. వేరే క్యాపిటల్ ఉంటే దాంతోనే పెట్రోల్ కూడా ఉంటాంగా. క్లియర్? Easy Shine is a startup company. Sir, maximum of the questions, sir, real case studies, sir. From last 3 attempts, they're asking only startup company related questions, private company related questions. These are the practicals. In previous days, they're asking about the private, public limiteds. They all are outdated problems. In recent times, they are focusing on real case studies, what happening in the market. Now, Easy Shine is a startup company that issues a brushless mission to wash cars. Suppose Easy Shine make an initial investment in equipment of rupees 6 lakhs. Can I use the word cost of the asset? 6 lakhs. The equipment is depreciated on straight line basis over 4 years to zero book value. Even though they not specify about the zero book value, conceptually we know if I follow the straight line basis, my value is 0. Okay. At the end of 4 years, the equipment will have a salvage value of rupees. Can I use the word entire amount is a capital gain? I need to pay capital gain tax. Okay. Easy Shine's marginal tax rate is 30%. Unless they specify, we are using the tax rate for all. Capital gain 30%, business tax also 30%. Next, the company is financed with 50% debt, 50% equity. Can I use the word weight of equity, weight of debt? Weight of equity 0.5 and weight of debt is 0.5. Total 1 rupee procured. Okay. The debt carries an interest rate of 6% and the cost of equity is 19.8%. Can I use the word 19.8 is a KE? Can I use the word 6% is a KD? Wrong answer. 1 minus tax. I said so many times, unless they specify. If they give a rate means it is a pre-tax. It is a pre-tax. If you done a mistake on that case, they will judge you. You don't know basics. Simply they judge you. You don't know basics. He was unworthy for 60. Guys, clear? Done. Sales, expenses, cash flows as per market sentiments. Highlight the, okay, go with market sentiment is one of the procedure there. As per market sentiments, they're doing a business. Okay. Sales for year 1 4 lakh, 5 lakh 20,000, 6 lakh 76,000, 8 lakh 78,000. Cost of goods sold is given. Gross profit is given. So I already said variable cost. If you reduce a variable cost, you will get a variable profit. That is nothing but gross profit. Out of gross profit or contribution, you have to reduce operating fixed cost. Now depreciation and marketing expenses are what cost? Operating. But operating income, they provided EBIT, but subjectively we know it is not EBIT. Are you clear? Why? Because you can check they're not reducing interest. The name is given EBIT. After EBIT, what you have to reduce? Interest only, na? What they deducted? Tax. Hope you guys you understand. Why? Because that interest adjustment happening at KO. Are you okay now? So don't follow the procedure. Follow the your statement point of view. Sales, less cost of goods sold, you will get a contribution. Less marketing expenses. Less marketing expenses, you will get EBDT. Then you can reduce the depreciation. Are you guys clear? Okay, done. Next, you have to reduce tax 30%. You will get operating income after taxes. Operating income, it is not a cash income. Accrual. If you add again depreciation, you will get after tax operating cash flows. Okay. Salvage value also given. How much? 15,000. Tax on salvage value 4,500. Why? Tax on salvage value. Capital gain. Next, after tax salvage value 10,500, you will get a CFAT for year 1, CFAT for year 2, CFAT for year 3. Year 4, when it comes to year 4, it is called CFAT. It is called terminal value. Total you will get at 3,63,080. Why? Because 4th year, at the end of the business, you have a 2 transaction. One is operating cash, another one is a terminal cash. The terminal cash only realized when it is a completion of the business. Guys, clear? Done. So total problem they done. The total solution also they completed. So if they completed means there is a something fishy. Now easy shine expect that it will have a year on year. Highlight the word year on year. Year on year. Sales growth 50%. Assume that cost of growth rate remains the same as per market production. Case 1, weighted average cost of capital. Case 2, based on 50% probability of both the market sentiments and easy shiny's expectation combined, calculate the NPV considering the both the situations. So if you watch this question first time, you will not get any clarity. So generally, what is the formula for NPV? Present sum of a discounted cash inflow minus sum of a discounted cash outflow. Are you clear? So if learn only this kind of knowledge, you have this kind of knowledge, you can take a direct solution here. Are you clear? Yes or no? But here two situations is there. Situation 1 is market sentiments. What they given is known as market sentiments. After market sentiments, they're saying that there is a changes in the market. You can observe the changes. Year on year sales growth of, it means what? Year on year means 1 year completed. They talks about the next year. If they not use the word year on year, you have to consider 0 to 1, 1 to 2, 2 to 3, 3 to 4. Guys, clear? Now the point is, year 1 4 lakhs, okay. What about the next year? It will increase by 50%. It will increase by 50%. It will increase by 50%. If sales changes, automatically cost CF rate also change, na? Now tell me, market sentiments point of view, you have a one NPV, and market changes point of view, you have a another NPV. Out of that, take 50%, 50%. As per market NPV, 50% value. As per change in market production, 50% NPV. Combine the two 50% NPVs, you will get an exact NPV. Guys, clear? Are you okay? One NPV point of view, they already provided. You have to calculate the new NPV. For new NPV, you have to consider the market changes. What are the market changes? Sales will be 50% change year on year. Are you clear now? Next, cost, what happened? Assume that cost growth rates remains the same as per market. Previously, how much they grown, take that only. Are you clear now? Okay. So students done doing a mistake mandatorily. Why? Because they will consider growth means they will compare these two. Last year 1 lakh, this year 1,30,000. How much growth happened? 30,000. They will convert the percentage. Last year 1,30,000. This year what happened? 2,02,800. Increases means grown only, na? Yes or no, sir? Okay. Last year 2,02,800. This year 2,63,640 grown. They will calculate these percentages. That is the wrong answer. Now, what is the right answer means? Sales always shows 100%. Out of cost of goods sold shows some X percentage. You will get a contribution or gross profit. Contribution or gross profit. Something called, for example, this is a 40%. Take an example. What is the gross profit? 60%. This is the basic stuff we are using in accounting and costing. Are you clear, sir? Now, so what is the cost of goods sold year 1 percentage? 4 lakh is 100%. What about the cost of goods sold? 1 lakh divided by 4 lakhs. 25%. Now what about the second year cost of goods sold? 1,30,000 divided by 5,20,000. Simple, man. So sales 100%. How you get this 100%? Sales divided by sales into 100. Cost of goods sold. How you get a percentage? cost of goods sold amount divided by sales into 100. Have you got a gross profit? Amount of gross profit divided by sales into 100. Clear? Yes or no? Now what about the gross percentage of second year? 25%. What about the third year? 30%. What about the fourth year? 2,63,640 divided by 8,78,800. Yes. These percentages you have to apply on new sales. This percentage you have to apply on what? New sales. Then you will get a new cost of goods sold. Guys, clear? Now what about the depreciation? It will not change. It's a fixed expenditure, na? Yes or no, sir? Now when it comes to marketing expenses, you can observe due to sales it also changes, means it is a variable nature. That's why you have to figure out the percentage. Now how much percentage? 80,000 divided by 4 lakh. 20%. What about the second year? 1,04,000 divided by 5,20,000. 20%. What about the year 3? 1,35,200 divided by 6,76,000. 20%. What about the fourth year? 1,75,760 divided by 8,78,800. 20%. Guys, clear? You have to apply this new old rates on new sales. Old rates on new sales. That is the meaning of assume that the cost of growth rates remains the same as per market predictions. Any doubts regarding this? Sure? Okay, done. The only point you have to understand is year 1 we are not adding 50% year on year. But that year on year is not saying for cost. Are you clear, sir? Cost point of view, they stopped the sentence. They after full stop they started. It means what? That year on year only for sales. Sir, marketing expense advertise means there's a common sense. All years will be same. Variable cost definition. Cost vary with change in level of sales. Fixed cost definition. Not change with but you can observe sales will be changes. The cost also changes. Clear? That's why I taken proportionately. Even though the name indicates the fixed nature, expenses are varies. But you can observe the depreciation. Clear? What's the illustration number? Problem number 16. Case 1. When it comes to case 1, estimation of weighted average cost of capital. Estimation of weighted average cost of capital. Which company? Sunshine, huh? Easy Shine. All are either Bangalore based companies or Mumbai based companies. These all are. So KO equals to, based on the question I understand there is only two sources. Cost of equity into weight of equity plus cost of debt into weight of debt. Now cost of equity specified in the question paper. If they not specify, you know how to calculate. Dividend model, earning model, CAPM. 99.9% cases they give CAPM. Clear, sir? So that too, how they give means at the top of the box is there, na? At the top of the box they will give a CAPM approach related. End of the top box is there, na? At that case they will give a weights and remaining all. Are you clear? So don't worry, if you write the formula, then where you procure the information, you know how to procure. Now cost of equity, how much? 198. What about the weight of equity? 0.5. What about the weight of debt? Okay, what about the KD? Given rate is not a KD, it's a pre-tax. Okay, tell me the pre-tax. 0.06 is a pre-tax. I want post-tax. 1 minus tax. 0.3, yeah? Into weight of debt 0.5. Now please tell me the answer. 0. Direct total answer. Exactly 12%. If you solve case 1, even they not give 1 mark. Are you clear? Okay, done. What's the case 2? Estimation of NPV for estimating NPV for Easy Shine Limited. Generally, NPV equal to sum of a discounted cash inflow minus sum of a discounted cash outflow. But Easy Shine saying that I don't want like a general, I want like a specific. Now, as per my instructions, as per my company, Easy Shine company point of view, now NPV equals to 50% of 50% on NPV of market production plus 50% on NPV of market changes. Guys, clear? As per market production, you have to figure out NPV. Out of that, you have to consider only 50%. Plus, change due to changes, you have to figure out again NPV. On that NPV, you have to consider 50%. Are you okay now? So, don't use a word called NPV, combined value. Combined value. Now, the combined value, how you get NPVs, you need to find out the NPVs of both. Now, do a working note for this. Working note 1. Calculation of NPV under market sentiments. So, shall we start from sales, or you can directly take the CFAT? We can take directly CFAT. There is no need of adjustments now. So why? Because of lengthy question, you have to short the answer. So due to market sentiments, frame the box. Years, CFAT or terminal value. Both are doing in one table only. Present value factor at the rate of case 1. Why we calculate case 1 for present value factor? Sometimes same kind of questions they will give. So entire problem, all information is available. With the help of present value factor, you will get an answer. But you write present value factor, but they not give any percentage of return. So I said always present value factor, we are using cost of capital or KO or minimum rate of a company or required rate of a company. That's clear? That's the purpose they are asking a WACC in case 1. So 12%. So you will get a present value of cash flow, cash inflow. Now year 1. So what's the CFAT? Year 1. 1,99,000. Please tell me the present value factor. 8928. What about the present value of cash inflow? 77,667. 6. When it comes to second year, CFAT please. 2,45,200. What about the present value factor? 0.779. Sir, either you can follow 3 values after the decimal or 4 values as after the decimal. Are you clear? There is no specification. Sometimes they will give a present value factor. If they give, don't calculate. Use that values only. Okay. But in a new syllabus, in inter and final, both the point of view, they are using only 3 decimals. Are you clear? So this not a that much of issue, but you can take that. It will appropriate to your valuation answer as well as your exam answer. It will be given near. If you follow the 4 decimals, it will gap between 100 or 200. It will happens. Okay. What about the present value of cash inflow? 1,95,472. When it comes to third year, CFAT 2,06,600. Present value factor 0.7117. Present value 437. 200,437. Okay. What about the fourth year? So go with the CFAT different and terminal value different. Then you will get a clarity. So first I am focusing on CFAT. Now what is the CFAT? CFAT only from operations apart from the scrap. Enta 52,580. It came from our day-to-day activity. Now what is the present value factor for that year? 6355. What is the present value cash inflow from operations? 2240. What, sir? Not 464, 70. Now again we missed one thing. At fourth year we have another transaction. What is the fourth year another transaction? Scrap salvage value. Total 15,000 you are enjoying, only part of the amount you are enjoying. Part of the amount. Why? Because you have to pay tax. How much is enjoyed? 10,500. It also came which year? Fourth year itself. You can go and check that years list. Fourth year. Now what's the factor value? 0.6355. 6,672. You can add and say you will get the same answer. You can show that differently also same answer. But it shows a presentation. Now answer. Answer. 8,04,003. Can I use it? It's called NPV. Can I use the word? It's called NPV. No, it's a present value of inflows. If you reduce the outflow, then only you will get an answer. You have only one outflow. That's why we are not doing any working note. Now less less present value of cash outflow. How much? How much? 6 lakhs specified in the question. Cost of the machinery 6 lakhs. Any working capital? Any working capital? No. Any subsidy? Any installation? Clear? Any replacement point of view votes? No. Now what is the NPV now? NPV 2,04,329. Don't take this 2,04,329. Take only 50%. What about the 100% means take change value NPV into another 50%. Guys, clear? Okay, now working note number 2. Working note 2. Calculation of NPV based on market changes. So here you have to start from sales to CFAT. Okay. Particulars. Year 1, year 2, year 3 and year 4. Percentage of growth in sales, or you can take directly. Can I use the word new sales? New sales. Why? Because changes happen na. New sales. Year on year. It means year 1 no changes. How much? 4 lakhs. Year 2 grown by 50%. Can I take 4 lakh into 1.5? 6 lakhs. Year 3 6 lakhs into 1.5. Year 4 9 lakhs into 1.5. How much? 13,50,000. This is the change happens. 50% grown means 100% equivalent to 9 lakhs. If you add 0.5 means 50% grown value directly. Are you clear, sir? Now, less cost of goods sold. Cost of goods sold. They said adjustment, previous adjustments. So write down here, cost of goods sold divided by sales into 100. You will get a percentages. Are you clear, sir? Now, what is the previous 25%? So please do this calculation down. So how much here growth, sir? 25%. What's the calculation part? 1 lakh divided by 4 lakh into 100. That equivalent to 25%. Now, what's the sale value? 4 lakh into 25%. Now, what is the sale value? 4 lakh into 25%. How much? 1 lakh. When it comes to year 2, what happened? 1 lakh, 1.3 lakh divided by 5.2 lakhs into 100. You will get a growth cost of goods sold percentage. 25% on sales only, na? Grown sales how much? 6 lakhs. 6 lakhs into 25%. 1 lakh 50. Okay. What about the year 3? I am writing direct percentage of growth. 30%. Okay, done. 30% on sale value. 2,70,000. What about the year 4 cost of goods sold percentage? Previous one 30%. Now 30% on new sales. 4,05,000. Guys, clear? Huh? Now, less market expenses. It also be in variable nature. That's why I'm reducing and at the time of cost of goods sold. Are clear, sir? I changed the book solution to understandable manner. Okay. Now please calculate percentage of expenses previous. What's the previous market expenses? Percentage, 20%. What about the year 2? 20%. What about the year 3? 20%. What about the year 4? 20%. Now please tell me the percentage of values. Market expenses divided by sales into 100. 4 lakh into 20%. 80,000. 1 lakh 20,000. 1 lakh 80. Okay. 2 lakh 70,000. Apart from this, I don't have any fixed expenses other than depreciation. Clear, sir? That's why I'm not using a word called contribution. Directly, I'm taking an answer called EBDT. Can I take directly EBDT? Are anyone confusing about the EBDT direct calculation? Clear? Now, EBDT. Please tell me the EBDT. 2 lakh 20,000. What about the year 2? 3 lakh 30,000. Year 3? 4 lakh 50,000. Year 4? 6 lakh 75,000. Out of this, you have to reduce depreciation. Less depreciation. How much? For every year, by 10 basis. So you will get EBT, taxable profit. How much? 70,000. 1 lakh 80,000. 3 lakhs. 5 lakh 25,000. You have to pay tax on this. Less tax rate, please. 30%. 70,000 into 30%. 21,000. 1 lakh 80,000 into 30%. What's it? 54,000. 90,000. 57,500. So next you will get an outcome name called EAT, earning after tax, or PAT, profit after tax. How much? 49,000. 1 lakh 26,000. 2 lakh 10,000. 3 lakh 67,500. Can I consider it is a operating cash inflow? CFAT. EAT is nothing but CFAT. Add back depreciation. If you miss that add back depreciation, your answer is wrong. Add again depreciation. 1 lakh 50,000. 1 lakh 50. Now you will get a CFAT every year. CFAT, please. CFAT after changes. 1 lakh 99,000. 76,000. 3 lakh 60. Okay. 5 lakh 70. 17,500. Add terminal cash inflow. Add terminal cash inflow. Are you receiving terminal cash inflow at year 1? Nil. What about the year 2? Year 3, nil. You will receive only at the end of the life. Are you clear, sir? I'm not doing all adjustments. I know the conceptual clarity. After payment of tax only, I will receive cash. There is no changes in a new parameter. That's why I consider old regime only. Old regime, what is the terminal value? 15,000 or 10,800. I sold for 15,000. I need to pay tax of 30%. After payment of tax, I will receive only 10,800. 500. 10,500. So, total cash flow after tax 1,99,000, 2,76,000, 3,60,000. Why this much of stuff? Multiply with present value factor at the rate of 12%. What's the present value factor? 12% first year. 0.8928. Second year. 7979. 717. 7971. 0.7117. 6355. Now, if you multiply with this cash flows, you will get a present value of cash inflow. Present value of cash inflow. Year 1. 1,69,632. Second year. Okay, we can write 1,77,667. Second year. What, sir? 2 lakh? Exactly. 220. What about the third year? 56,000. 213. 212. Fourth year, you have to consider 5,17,500 plus 10,500 totally. 3,55,000. Sorry, 35,553. Okay, done. NPV equals to summa. Go with the uniformity formula. Present value of cash inflow minus present value of cash outflow. So please sum all present values. Nine lakh 89,000. 499. For 9 lakh 89,000 423. Sir, round off. Okay, sir. Present value of cash outflow is only one thing. 6 lakhs. Now NPV, please. 3,89,433. 423. I don't want this entire NPV. I want only 50% of this. Now come to case 2 answer now. Up to now we just discussed only working notes. Now when it come to combined value 0.5 into 2,04,329. 2,04,000 into 329 plus 50% into 3,89,000. 3,89,423. Now please tell me the combined value. 0.5 into 2,04,329 M plus 0.5 into 389,423 M plus MRC. 2,0876. This is called combined value. If you ask this question for 7 marks, you have to complete within 8 to 9 minutes. The shortcuts are very, very important. So a lot of times there is a differentiate between our presentation as well as book presentation. Sometimes you feel book is a easy one, sometimes feel it's a notes is a easy one. My point of view is the easy one. You can take your own decision. So comparing to book and my notes, if you think your presentation is good, go with that. But just think, if you do like this, they will give 7 marks or not. Are you okay? So chapter 1 is completed. So when it comes to some theoretical stuff is there, not that much of important for theoretical questions. It's important for MCQ purpose. Lot of things I already covered in intro class. Now just go with the overview point of view. This is a MCQ. The first heading is there now. It's not a quotation on auto. It's a quotation on BV. So companies that grow and earn return on capital that exceeds the cost of capital, it's called a create value, said by whom, sir? Alfred Marshall. He was an economist. As per Alfred Marshall, they will ask a question or they will give a definition. Who said this? Are you clear, sir? One MCQ is there. Now when it comes to what is business valuation, business valuation is an activity conducted towards a rendering. The word rendering means estimating or find outing. Rendering an estimate or opinion as to the fair market value of a business interest at a given point of time. These words are split into special points. Valuation done at point of time. Stock concept. Price is different, value is different. Valuation is a subjective concept. Clear? Now, a business valuation requires a detailed understanding of variety of factors affecting a value. They need a professional judgment and experience as well as knowledge and skill. Now, some important points while doing a business valuation. Valuation is a subjective concept. You know that. It's different from value to value. Valuation is not the same as price. Now they said Warren Buffett provided a clarity about this. Price is what you pay, value is what you get. In simple terms, you can take a simple example. If I purchase one share at 10 rupees, I need to pay 10 rupees. That is called price. After 2 years, I am selling that share. How much I will receive? 10 or more than 10 or less than 10? More than 10 or less than 10 is the question. Anything can happen. You can receive only 10 rupees, you can receive less than 10 rupees, you can receive more than 10 rupees. You can receive 10 rupees, there is no discussion of price and value. If you receive less than 10 or more than 10, that is called value. Guys, clear? Done. Valuation is done at a point of time. We are not doing every month or every week. Valuation requires a good understanding of the following: business and business environment, that is nothing but SPM. Regulatory environment and laws called DT and law and compliances. Accounting framework called FR. Valuation methods and principles. Calculation of spreadsheets and application. Time value of money. If you know all those things, you can easily do a valuation. So this collectively known as valuation is a multidisciplinary in nature. Clear? Next, some important key terms in valuation. Sir, there is not that much of differences, sir. There is a slight differences between the words. Fair value, fair market value, market value. Every student confusing on these three. Fair value, fair market value, market value. Sometimes instead of fair market value, we are using market value. in calculation point of view. But when it comes to the definition, you have to learn properly what is the difference. Why? Because they ask MCQ. Now see, the word market value means, it's called estimated value. The word market value means what, sir? Estimated with the help of the methods we have. Are you okay? The word fair value means actual price in the market. What is the keyword? Actual price in the market. The word fair market value means the amount is known by buyer and seller. The amount known by buyer and seller. Willing buyer, willing seller is a keywords. Now see, market value. The estimated amount for which an asset or a liability should be exchanged on the validation date between the willing buyer and willing seller in arm's length transaction. The word you have to focus here was what, sir? Estimated value. The word market value means estimated value. Next, when it comes to fair value, the price that would be received to sell an asset or paid. The what is the mean for received and paid? Actual. The received and paid means what, sir? Actual value. The transfer a liability in an orderly transaction between market participants at the measurement date. So the actual value transfer between the buyer and seller is known as fair value. The estimated value transfer between the buyer and seller is known as market value. Now let us check the fair market value. The price willing buyer would pay willing seller in a transaction on the open market, and the both having a what, sir? Reasonable knowledge. Purchaser know how much it is, seller know how much it is at the market conditions. Next, when it comes to liquidation value, so the word liquidation means you know. What is the mean for liquidation? Closing. It may be forced, it may be by order of the court, or it may be forced. Are you clear? Two types of liquidations is there. Okay, done. The liquidation value, the amount that would be realized when assets are a group of assets. Can I use word? The group of assets is nothing but slump sale. Individual asset as well as group of assets are sold on piecemeal basis. Liquidation value can be determined under two premises. One is orderly transaction, another one is a forced transaction. Orderly transaction means court will give a sufficient time for a liquidator sold that assets to public. They will give a lot of time. So sometimes court will give a notice, sell at any cost, even though their market value is less. Liquidator saying to court, sir, if I sold that asset today, we will get only less than the market value. Are you clear? That's a transaction put in front of the judge. Now judge have a two versions. Okay, then take a time. When you get that good market value, sold that time. That is called orderly transaction. Another version, at any cost you need to sold, settle to creditors. That is called forced transaction. Are you clear? Done. So the orderly transaction with a typical marketing period, the forced transaction with a shortened marketing period. The word typical marketing period means sufficient time. The word shortened marketing means they will not give any time. Are you clear, so? Now, investment value, amount you invested in any company or asset, the value of putting that money is known as investment value. So the value of an asset to the owner or a prospective owner given individual investment or operational objective may also be known as a worth. Are you clear, so? Now, equitable value. So this is the estimated price of the transfer of an asset or a liability between identified knowledgeable and willing parties that reflect the respective interest of those parties. You can observe this equitable value is similar to fair market value. To sell my property for 100 CR. Now buyer is willing to buy for 100 CR. Are you clear, sir? My CFO, my CMA valued my property for 100 CR. Their CMA, their CFO valued for 100 CR. That is called equitable value. But maximum of the case, what happen? Either we can charge more value or they can charge less value. After the disturbances, we will negotiate each other. Are you clear, sir? So that is the difference between fair market value and equitable value. Okay. Next, the concept number 3, write a short notes on difference between fair value and market value. So generally, US GAAP and IFRS, they saying that there is no difference. There is no difference. But when you're doing a valuation, different circumstances, you are using different words. That's why the differences is came. Let's check this point. There is no authoritative clarification either under US GAAP or IFRS about the difference between fair value and fair market value, except that these terms are consistent in accounting. Unless these terms, remaining all cases, fair market value and not fair market value and fair value both are what? Same. Now what are the except point? The first point is fair value has a hierarchy of inputs or valuation for a valuation, but fair market value does not have it. So hierarchy means, so what the words are used for fair value? Estimated value or actual value? Actual value. Actual value be decided by a management. Actual value decided by a management. I will sell my property for this much. I can't agree for less value, more value. I sell this. Clear, sir? So who will decide? Hierarchy. But fair market value, no person can't decide. Why? Because different methods give a different answers. Different methods give a different answers. Guys, clear? Sir, when it comes to fair value, sir, I will purchase your company 4x into your sales. I will purchase your company 4x into sales. For example, your sales is 100 lakhs. 400 lakhs. That's called fair value. But when it comes to fair market value, I can't use that 4x. I use this discounted cash flow method. I use this value of share method. I use this net assets method. Different methods I will calculate and find out the value. Then I will tell to you. The differences will be came because of fair market value. Why? Because they are not follow the hierarchy. They follow the CFO. They follow the methods. Next, fair value consider highest and best use. That is means I already said highest and best use. Estimate or future of the asset, not about the current usage. So there is an example of Vijay Mallya mansion. So why they purchased for that much of crore rupees means they observed the future growth on that property. Guys, clear? Now, the asset from the perspective of market participant, they may result in the maximizing the value as against the consensus value under fair market value. Simple. Fair value consider highest and best use. Market value not consider highest and best use. Why? Because they will follow current use also. At time they need a valuation. Next, when it come to DOLM, write down discount for lack of marketability. Discount for lack of marketability. So just for MCQ purpose. These all are definitions. Straight MCQ. So discount for lack of marketability. So when it come to if your assets or your shares don't have any marketability in the market, even though you are ready to sell, very clear. As per fair value, you can take that discount percentage for valuation. But as for market value, you need not to consider DOLM. Clear? Every time we can't expect that much of market for our company. Sometimes there is a less market, sometimes there is a more market. For example, in COVID situation, anyone is ready to buy anything? That time we are using DOLM as per fair value. We can't use DOLM as per fair market value point of view. Next, fair value disagreed blockage discount. Fair value disagreed blockage discount. If fair value disagree means who agrees? Market value agrees. The word blockage discount means, for example, I am ready to sold 10 lakh shares. I am ready to sell 10 lakh shares at 20 rupees. At 20 rupees. Now how much? 200 lakhs, huh? 200 lakhs. It's called fair value. It's called fair value. 10 lakh shares is there. I sold for 18 rupees. 180 lakhs. Are you clear? The amount 2 rupees is there now. That is called blockage discount. That is called blockage discount. I am ready to sold 20 lakhs. At any cost I need to sold. Are you clear? So that's why I providing discount. If I provide discount, that much of my organization value reduces now. So don't reduce your organization value set by fair value. You can reduce your value. You want only money set by market value. Guys, clear? That is the meaning of blockage discount. Okay, after this, purpose of valuation, you already know. IPO, buyback, estimate planning, merger and acquisition, insolvency and liquidation, business reconstruction and slump sale, shareholder dispute settlements. So valuation premise we already discussed. So apart from this, there is a premises is there: highest and best use, current use existing, orderly liquidation, forced sale, going concern. The only thing you have to learn: going concern and orderly current use. You already know the highest and best use. It means it focusing on the estimated value and the future growth. That's the purpose. You have to check the physically possible, financially feasible, legally allowed. So every time if you observe the word of highest and best use, take an example, Vijay Mallya Mansion. You have to check physically possible, financially feasible, legally allowed. These three conditions satisfied. Sold by court, legally allowed. If you use for business purpose, there is a more revenue you will receive. Physically possible, yes, it's a tangible thing. Guys, clear? Next, when it comes to current use and existing use, here I am not focusing about the future. At present, what is the working condition? If I sold presently, how much I will receive? So there is an alternative name for current use and existing use is as is, varies. That is a very, very important word. They can frame a MCQ based on that word. Are you clear? Now, orderly liquidation, I already said. If court give a sufficient time to sold the asset, that is called orderly liquidation. What does it mean for forced sale? Court not give sufficient time. Going concern principle, you know that. Whenever purchasing a business or asset, not asset, whenever I purchase a business, my expectation is it will be survive lifelong. Yes or no, sir? Now, the note points are very important. The two notes are two MCQs. Businesses are valued using going concern premise in case where businesses under stress, they may be valued on liquidation or forced sale premises. All cases you can take a going concern premises. All cases you can follow what, sir? Going concern. If your company at stress, can I use the word liquidation time or bankruptcy time? Stress means what? Financially you are not strong. At a stress time, don't use going concern, use liquidation or forced sale premise. Are you okay? Remaining all situation, remaining all purposes, you can take an assumption of what? Going concern. Except the time of stress. Financially weak. If financially weak, don't. That's a means. If financially weak means in a short time I will close the company. Yes or no, sir? At the time I can't take a assumption called going concern. Note 2. Tangible assets are usually valued using any of the premise except going concern. What does it mean that if you're doing a valuation of assets, we have two types of assets: tangible, intangible. For a tangible, you can use all premises except going concern. It means going concern only for intangible things. For example, you are doing a HR valuation, human resources valuation. Tangible or intangible? Intangible. That time you have to take an assumption called what? Going concern. Are you okay? Goodwill valuation, brand valuation, going concern. Bike valuation, You can take any premise, no issue. Note points are very, very important other than the definitions. So that's it, guys. Next, when it comes to approaches, 3 approaches we have: a market, income, cost. Market have 3 methods: market price method, company comparable multiples, company comparable transaction method. Income approach have 2 methods: discounted cash flow method, profit earning capitalization, or capitalization of earning. Both are the alternative names. Cost approach have 2 methods: replacement cost method, reproduction cost method. That's it. Remaining concepts we will discuss next class, and we will solve the MCQs. Okay, thank you. Why market expenses percentage is taken from old sales model, sir? They mentioned clearly in the question, Nana. That's why we taken from old sales. So at the bottom of the question, you can observe the bottom of the question. Easy Shine expect that it will have a year-on-year sales growth of 50%. Assume that cost growth rates. They specified the word called cost. Here, cost of goods sold and marketing expenses is the cost for us. That's why we consider as per market predictions.